Based on the provided document, here is a summary of the key information on accident and sickness insurance. Accident and sickness insurance. Accident and sickness insurance is often referred to as health insurance. This type of insurance is designed to supplement the basic coverage provided by provincial and territorial health plans in Canada. Key areas covered by this insurance include extended health care. This coverage goes beyond the basic provincial plan to include benefits like semi-private or private hospital rooms, ambulance services, prescription drugs, and private duty nurses. Travel insurance. This augments provincial coverage when traveling outside of Canada. It can cover expenses for medical care, as well as repatriation of a body in the event of death abroad, which can be very costly. Prescription drugs. There are two main types of plans for prescription drugs. Reimbursement plan. The individual pays for the prescription out of pocket and then submits a claim to the insurance company for reimbursement to pay direct plan. The individual uses a card at the pharmacy, and the pharmacist charges the insurance company directly, so there is no out-of-pocket payment by the individual. Dental plans. All dental plans must include a basic preventative coverage. This covers services like examinations, consultations, x-rays, fillings, and anesthesia. Accidental death and dismemberment. AD&D pays a benefit if death or dismemberment is caused by an accident. There are specific exclusions such as death from war, suicide, or a criminal act. The full amount is paid for accidental death. For dismemberment, such as the loss of an arm or leg, a table specifies the amount paid. Losing two body parts, e.g. two legs or an arm and a leg, typically results in the full benefit payout. The death or dismemberment must occur within 365 days of the accident for the benefit to be paid. Critical illness and long-term care. These are also commonly included in health insurance plans. Deductibles and coinsurance. Insurers use deductibles and coinsurance to lower their costs and reduce frivolous claims, which can in turn reduce premiums. Deductible. A deductible is an annual amount that must be paid by the insured before the insurer begins to pay. If a claim is for $300 and the deductible is $100, the payout will be reduced to $200. Deductibles can be a single deductible for each person or a family deductible for all members combined. The single deductible is applied when a family member makes their first claim in a given year. Once the family deductible has been met, no further deductibles are applied for any family member for the rest of the year. Coinsurance. Coinsurance is a percentage of the claim that the insurer will pay after the deductible has been satisfied. For example, with an 80% coinsurance and a remaining claim of $150 after the deductible, the insurer would reimburse $120. Coordination of benefits. When an individual is covered by more than one plan, such as two spouses each having a group plan through their employer, the government has rules to prevent them from being reimbursed more than they spent. These are called coordination of benefits rules. The plan that does not coordinate benefits pays first. When both plans have coordination of benefits, the claim for a primary member, e.g. a spouse, goes to their own plan first. The primary plan's reimbursement is calculated, and any remaining out-of-pocket expense is then submitted to the second plan. The second plan will pay the lesser of the out-of-pocket expense and what it would have paid as the sole insurer. For a dependent child, the claim is submitted to the plan of the parent whose birthday falls first in the calendar year. Taxable benefits. The tax implications of an insurance benefit depend on who paid the premiums. This is relevant in an employer-employee relationship. Employer pays all premiums. If an employer pays the entire premium, the benefit received by the employee is considered taxable income. Employee pays all premiums. If the employee pays all the premiums with after-tax dollars, the benefit they receive is tax-free. Shared premiums. In many group plans, the employer and employee share the premium costs, such as 50/50ths. In this case, the portion of the benefit equivalent to the total premiums paid by the employee is considered a tax-free return of premium. Any amount received beyond that is considered taxable income. This is because the employer's contributions are not taxed when paid, but the employees are.